Inflation under the spotlight on both sides of the Atlantic. Welcome to Market Insight. I'm Peter Devlin. In France, inflation edged higher in July, rising by 2.7%, while in the UK it rose to 2.2%, but that was less than predicted. Meanwhile, US CPI came in at 2.9% on an annualized basis, a touch lower than expected. So what do all these readings mean for policymakers at the Fed, the Bank of England and the ECB? Well, to help answer that and more, I'm joined by Vicky Pryce, Chief Economic Advisor at CEBR. Welcome, Vicky. So starting off with the US, and inflation is softening, but so is the economy. Is a jumbo 50 base point cut warranted from the Fed?
Yes, I think it is. What we've seen is a softening. We got the data yesterday in producer prices in the US, and now we've seen also that headline inflation is below 3% to 2.9%, which is actually good news. It's better, in fact, slightly better than some forecasters were anticipating, but it's more or less what people thought in terms of the trend that we had seen already in inflation in the US. And it also goes together with the general feeling that there is a slowdown in the economy, not the recession that perhaps the market worried about just a couple of weeks ago, but certainly a slowdown. We've seen that reflected a little bit in the jobs data that's come out of the US, but generally I think the feeling is that interest rates will have to come down, and probably come down more than maybe had been anticipated just a few months ago, just to make sure that when those rates are cut, possibly by 50 basis points in September, in the US, that the markets will react positively, because if they cut perhaps by anything less than that, we might get that volatility returning.
Well, Vicky, one central bank that has started easing is the ECB. Will recent data encourage or discourage them from making more cuts this year?
The inflation data that's coming out would suggest that there is a lot of divergence in Europe, and we've seen, indeed, you mentioned France, and I think Germany also has seen a little bit in the preliminary data that we've seen of an increase in inflation, and has problems with wages as well. But on the other hand, what we're seeing is that a number of other countries are enjoying a further decline in inflation. We've seen that, for example, happening in places like Portugal. And some of the smaller countries have seen a bit of an improvement taking place. So it's not all on the up. In fact, I think there are some other indicators that suggest that for the Eurozone overall, what we might see is inflation in July at around 2.5, 2.6% when all the data is out. And that also suggests that we're very close and have stayed close to the target of 2%. We have indeed, as you said, seen a cut there of 0.25% happening a couple of months ago, and I think the expectation now is that the next meeting will see a further cut, and I think that is what the markets want. I mean, just look at what's going on with the German economy in particular. Yes, of course, there are issues with wages and inflation right now, but it looks pretty bad in terms of industrial production there, and we've seen sentiment indicators in Germany dropping very significantly, and actually they've dropped very significantly in the Eurozone too. So if we were looking at one particular part of the developed world where we may need to really worry about the slowdown in growth, then that is the Eurozone.
So back over to the UK now, and again that inflation ticked higher, but by less than expected. The rise in services inflation came in significantly lower. The markets do seem to be gaining confidence that they may be at 2 rate cuts to come this year. Do you think they are right?
Yes, I think the markets seem to think we may see something in November and perhaps in December, but we might see it earlier. There has been an improvement in the service inflation, as you rightly said, down to 5.2%. It's still not perfect, but there are also some reasons why that is the case right now, which could perhaps be, if you like, sort of made to disappear from the system. I mean, this is what happens with 12-month comparisons, if you look at year-on-year rates. But overall, what we're seeing is that there is quite an improvement in the underlying situation. Wages are slowing down. We had the data come out yesterday. When you look at producer prices and you also look at input costs more generally, what you see is that input prices, even though they're up by 0.4% year on year for producers, so mostly manufacturing, what you're also seeing is that on a monthly basis, we've seen a fall of 0.1%. And also we've seen absolutely sort of no change on a monthly basis in terms of wholesale prices. So that suggests that there isn't a lot of underlying pressure on inflation coming from production, because of course at the end of the day it gets reflected in what happens to consumer prices. So what we're seeing is an improvement overall, and of course, yes, inflation data was slightly higher than it had been in the last couple of months, so 2.3% instead of 2%, which was bang on target. That really reflects mostly energy prices, because we saw a fall in energy prices a year ago, which was sharper than what we're seeing now, and that inevitably therefore leads to inflation year on year being slightly higher. But the underlying trend, nevertheless, is one of slowdown. And for the month, we saw CPI, Consumer Price Index, come down by 0.2%.
Vicky Pryce at CEBR, many thanks for your thoughts. And that's your market insight. Don't forget you can watch more videos on Reuters.com.